So, where were we last time? We were on risk return and the capital asset pricing model. And we had just finished talking about systematic and unsystematic risk. Does that sound right?
Yes.
So, can anyone tell me which one of those we can diversify away?
Unsystematic.
Yeah, we can diversify away the unsystematic because that stuff isn't affecting basically everything. But we cannot diversify away the systematic. So, I always remember it this way. Systematic is undiversifiable and unsystematic is diversifiable. So they're just the opposite where we put the uns. Okay, now let's talk about what that means for portfolio risk. And I want to remind you that I told my conversations with my dad when we're talking about how many stocks we have in our portfolio. And I asked him if he's well diversified. He said yes, he had 12 stocks. We're going to see today if 12 stocks is enough to be well diversified. So what happened was these finance professors, they did a study. And they programmed a computer. And they told the program to go out 10,000 times and randomly pick a stock and hold it up and measure the standard deviation of returns for that stock. And when they did that, the average standard deviation that they got for that one stock portfolio was 49.24%. And then they said, okay, computer, now we want you to go out there and pick up two stocks at the same time and form an equally weighted portfolio of those two stocks, half this one, half that one, and figure out what would be the annual standard deviation of returns for that portfolio. We're going to do that 10,000 times. We're going to take the average. And when we did that, the answer was 37.36%. Now, let's look at the final column. The final column is calculated by taking the current standard deviation and dividing by the standard deviation of the portfolio with only one stock. So the portfolio with only one stock is our baseline. And so when we divide the standard deviation for this, one divide by that same thing, we get 1, which makes perfect sense. Now, if we do the standard deviation of two stock portfolio, we can see that this comes out to be 0.76, which means I have dumped 24% of the total risk by just adding one stock to my portfolio. That's pretty cool. I can dump 24% of the risk by just holding two stocks instead of holding one. Okay, now let's move on. Let's double it again. This time we're going to pull 4 stocks and we're going to equally weight the portfolio among those 4 stocks. And now the standard deviation is 29.69%, and when we divide that by 49.24, we get 0.60. So now by having 4 stocks, we have gotten rid of 40% of the risk. But I want you to notice something. The first doubling dumped 24%. The second doubling only dumped 16%. We went from 0.76 down to 0.60. In other words, there is a diminishing reduction in the risk as we add more stuff into the portfolio. So let's take a look. We're going to skip over 6 and let's look at 8. 8 takes us down to 24.98% standard deviation, so that gives us 0.51. So another doubling takes us from 0.6 down to 0.51, which is just a difference of 0.09. And so you can see that as we add more stocks to the portfolio, we are going to get a reduction in risk. But that reduction in risk becomes smaller, 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 smaller. Now, here's a fun exam question. If I have a portfolio with 1 million stocks in it, and I can find another stock that is not correlated to the portfolio, is there any benefit to adding that stock? There is, but it's just really small, right? So we never stop getting benefit from adding stocks to our portfolio. The benefit just gets smaller, smaller, smaller. Now, as a practical matter, Right now I've got probably 1,100. Oh hell, I've got more than that. So I've probably got over 2,000 stocks in my portfolio. Would it really, as a practical matter, be worth my transactions cost to go out and buy some more? Probably not. But as a technical matter, absolutely. I do get additional diversification benefit by adding one more stock, as long as it's not perfectly positively correlated. Now let's take a look through here. Look at that fraction over here on the right side. Notice that it starts to get 0.42, 0.42, 0.41, 0.40, and then it changes to 0.39, 0.39, 0.39, 0.39, 0.39. And that happens in the neighborhood of, what, 200 stocks? It's hard to see from this angle. Yeah, in the neighborhood of 200 stocks. So we would say, you're fairly well diversified if you have at least 200 stocks. Now, let's go back to my dad, and let's just say 10, because we don't have 12 on our list here. He is getting rid of 51% of the risk. But if he were to have 200 stocks in his portfolio, he could get rid of 61% of the risk, which is a nice increase in the amount of risk gotten rid of. The other thing I'm going to tell you is I think my dad's not at 0.49, and here's why. The stocks that he holds are all of one type. They're all electrical utilities because those are supposed to be safe stocks. But what do you think is true of the correlation of those things? Yeah, it's higher, and so as a result, his diversification benefit isn't as much as it could be. If he had stocks from 12 different industries, he would have a better diversification benefit than he does having 12 electric utilities. Does that make sense?
Yes.
Okay. Now, for those of you who are not number people, but you are graphical learners, visual learners, here we go. This is exactly the same thing presented as a graph. And the brown line there is what is called total risk. Standard deviation is our measure of total risk. Standard deviation is our measure of total risk. And what we see there is as we add more stocks, by the way, the x-axis is the number of stocks. As we add more stocks, what happens is that brown line drops down, but it starts to level out. Now, it never truly does. It becomes what we call asymptotic. And asymptotic is where a curve gets closer to a line, but it never quite touches. You could think of an airplane coming in for a landing, and every mile it goes forward in the air, it drops half the remaining distance to the earth. And you just keep doing that. Now it's going to get closer and closer to the earth, but is it ever going to touch down? No, it keeps dropping half the remaining distance, right? This is an ancient Greek paradox. Plato, I think it was, said, if you walk half the way across the room and then you walk half the remaining distance and half the remaining distance, and he asked this question a bunch of times. He says, are you ever going to make it to the other side of the room? And the answer is no, because you will always leave half the remaining distance, right? So what's going on here is this diversifiable, or the total risk, is going down, until it becomes asymptotic at the level of non-diversifiable risk. This is how we empirically determine how much non-diversifiable risk there is. We've come up with these numbers and we figure it out. Now, do you think it changes over time? Yeah, you can't say forever and a day it's going to be 19.2%, but in the case of this experiment, that's what it came out to be. And we can say that it looks like it's less than half of the total risk if we hold one single stock. Okay, now what else is there?
Call that brown line again, the total what?
So the brown line is the total risk.
Just total.
Total risk. The blue line is the systematic or non-diversifiable risk. And that whole brown area is the diversifiable risk. It's what we can get rid of. Now here's another test question. As I add more stocks to the portfolio, the total risk declines and becomes equal to Some people will say 0. That's not right. It'll become equal to the diversifiable or to the undiversifiable risk. Now, another way to phrase that question is, as I add more stocks, the diversifiable risk of the stock goes to 0. As I add more, the diversifiable risk of the portfolio, I should say, goes to 0. And so there's two ways to couch that question. So be prepared for either way. Total risk never goes to 0. Diversifiable risk can go to 0 if we have enough stocks. Any questions so far?
You just said diversifiable can go to 0?
Yeah, diversifiable risk can go to 0
I
because
thought it was asymptotic.
as well, it gets to damn near 0.
Okay.
Yeah, you're right, smartass. You're absolutely.
No, I'm not.
I know, I'm just giving you grief.
I mean,
No,
I can
that's-
see where it never hits.
Yeah,
There's
so-
always going to be some risk. But
Yeah, so it gets really damn close to 0. That's an excellent point, thank you. Other questions? I'm sorry, I try to call at least one person a smartass every day. It was just your day. Okay.
Lucky day, I guess.
Yeah. So I usually have picked up 4 or 5 smartass comments at me. I mean, people calling me that by the time I get in here, right? So I have spares to give away. Okay. But I will tell you this, it's better to be a smartass than a dumbass, right?
Right.
Yeah. Okay, now let's talk about our different measures of risk. Remember, we said standard deviation is a measure of total risk. But we said because we can diversify away diversifiable risk, it's not priced. And so we need to figure out a measure of the non-diversifiable risk or systematic risk. Hang on, I gotta mute my watch, there we go. We've got to diversify that, sorry, now I've lost my train of thought. We need to find a way to measure systematic risk because that's what the market prices. And the measure that we've come up with is called beta. If you've ever been involved with Greek stuff, then you understand that this is, that's the uppercase beta or lowercase beta? I forget. Lowercase beta, very good. Oh, we have a Greek person. Excellent. Okay, so she has an advantage. Okay, so this is beta, and it's how we measure the systematic risk. And we talked last time about why the market was only concerned about systematic risk. Can anyone tell me why?
Because it can affect all the market.
Yeah, and why aren't we concerned about unsystematic risk?
So we can diversify.
Because we can diversify it away. Because we can diversify it away. Very good. Okay, now let's talk about how we come up with beta. So last time we talked about the capital markets line that went through the risk-free asset and the market portfolio, and now we are on to another line. By the way, this is line 2 of 3. We're going to have 3 lines in this chapter. This is the characteristic line. And how do we find the characteristic line for a security? Well, we put the return of the security on the vertical axis, and we put the return of the market on the horizontal axis. And we plot the different returns of the stock versus the market. And then we can do a linear regression, and we can fit a line to that data. And the slope of that line is beta. The slope of that line is beta. And so now we can interpret beta. What's the real meaning of beta? If I have a stock with a beta of 3, when the market is up 1%, the stock is up 3%. What if I have a stock with a beta of 6? When the market is up 1%, the stock is up 6%. And so far you're saying, wow, I want to find the highest beta stock possible. What's the downside?
There's more risk.
There's more risk. And so when will that risk rear its ugly head? When the market goes down, right? So you've got your stock with a beta of 3. When the market's down 1, the stock with a beta of 3 is down 3. But the one with a beta of 6 is down 6. And so the higher the beta is, the bigger the swings, And you remember we said that these swings are a sign of risk, right? They are risk. And so therefore, the higher the beta, the higher the risk. Now let's ask this question. What do you think is the beta of the market? What's the beta of the market? It's a number. 3. How about this? So remember we said that what we're doing is we're regressing this versus the returns on the market. So if I have the returns on the market regressed against the returns on the market, basically I have a 45-degree angle line there, right? Because when the market's up 1, how much is the market up? 1. And when the market's down 3, how much is the market down? 3, right? So the beta of the overall market is 1. The beta of the overall market is 1. The beta of, you're not writing it down. The beta of the overall market is 1. The beta of the overall market is 1. Okay, now, remember we said that beta is a measure of systematic risk. And what do you suppose then is the beta of the risk-free asset? What's the beta of the risk-free asset?
1, right?
No, that's the beta of the market.
Or the 0.
It's 0. Remember, it's risk-free. Beta is a measure of systematic risk. If it's risk-free, then it should have a beta of 0. If it's risk-free, it should have a beta of 0. So we could apply this characteristic lines to lots of different things, and the slope is always going to end up being beta. By the way, slope, I will get to that in a second. Okay, so let's talk about some betas for different stocks and what they mean. We have American Electric Power. This is the kind of stock that my dad likes. And the reason he likes it is because it's low risk. And what does he mean by low risk? It's got a low beta. Now, the other reason he likes this stock is because it pays dividends. So he's looking out of this, he's looking for dividends, not for capital gains, right? Okay, now what happens though when the market is up 1%? How much is American Electric Power up? When the market's up 1%, American Electric Power is up how much? 0.32%. So what's up 1%? What about when the market's up 2%? Yeah, 0.64, right? 0.64. Now, so what does that mean? When the market goes up crazy, like it did in 2023, did my dad's portfolio swell all that much? No. Now, what about when the years when the market has taken a huge, giant dump? When the market is down 10%, how much is my dad's portfolio down? 3.2%, right? And so on the upside, he's not gaining when times are good, but he's not losing all that much when times are bad. That's safety. That is a lack of risk, or I should say that shows that we've got a small amount of risk. Now, why is American Electric Power, why is it a low beta stock? Well, let's think about what they sell. What do you think they sell? Yeah, electric power, right? They sell electric power. Now, let's talk about how this works, because basically the idea is this. The economy is either up or down. And if the economy is, let's say, up, then we assume the market's going to be up. If the economy is down, then the market is down. Now, let's talk about how the overall economy would impact American Electric Power. In the United States, it's only a small portion of our electricity that goes to industrial uses, like making steel or cars or things like that. And so what we see is electrical use doesn't fall all that much during a recession. Does that make sense? Because most of the use is residential. When times are tough, do you go home and turn off all your lights and sit in the dark? No, you still come home. Well, you probably do that during good times too, though. You've got a beard, right? Okay. I like the beard, by the way. It looks good. Okay, now, so what we're saying here is that, and when times are good, Do you come home and turn on all the lights in the house? And then like turn on a space heater and then turn on your air conditioner just to make them fight each other? No. So what we're saying here is the economy does not really impact overall the residential consumption of electricity, and that is the overwhelming big portion of American Electric Power's business is residential. Now let's talk about during good times. Industrial production is up a little bit, so you're gonna, or it may be up a lot, but remember that it's only a small portion of their business that is industrial electricity, so sure, the consumption is gonna go up, their profits are gonna go up during good times, but not like they would if they were selling something that was truly cyclical. By the way, we'll get into cyclicality, but here's the general idea. Cyclical things sell more when times are good and less when times are bad. Okay, now let's talk about Johnson & Johnson. What does Johnson & Johnson make?
Everything.
Everything. So let's narrow that down. Do they make superfluous things that people really don't need? No, they're making what, Band-Aids? Let's just look at Band-Aids. Do you think someone cuts their finger and says, man, I'd love to put a Band-Aid on that, but I might lose my job next week because the economy really sucks? Does that happen? I would hope not. I would hope that you put a Band-Aid on it regardless. Now, what about you cut your finger and you're just about to get a big promotion at work? You're like, I'm about to get a big promotion. I'm going to put 2 Band-Aids on that. Does that make sense? No. So they're kind of like American Electric Power in that they don't sway that much with the market. Tyson Foods. What is Tyson Foods' primary product? Chicken. Have we discussed why chicken is cheaper than beef? Yeah, it takes 4 pounds of grain to put a pound of meat on a chicken. It takes 10 pounds to put a pound of meat on a steer. Tyson does do some beef, but still chicken is the overwhelming majority, and that makes total sense. Because in good times, people might buy slightly more chicken, but in bad times, they're not going to give up chicken like they would, say, beef. Now, then we've got Allstate Insurance. Where do you think, so by the way, the first 4 of those, are they more risky or less risky than the overall market? They're less risky, because remember the beta for the overall market is 1, and the higher the beta, the riskier it is. Okay, so Allstate, they do insurance, they're getting close to that market, and so is 3M. 3M is a conglomerate, and it comes close to your, what do they make? Everything, right? 3M makes all sorts of crap, and you would never even suspect it. And so it makes kind of sense that that they react similarly to the market. Now, what do Hewlett Packard and Dell do?
Personal computers.
Yeah, so they're big into computing, technology, and it makes sense that those things would have a beta that is riskier than the market. Here's why. If times are good, and I've been in companies when this happened, times were good, we had extra money, and what did we do? We went out and replaced our computers at the end of the year. Because sadly, a lot of organizations, if you have budget and you don't spend it, what happens? You lose it. So anytime you've worked with a government or a regulated utility, it was actually a nuclear plant where I was working where we all got brand new computers and we're like, what the hell? And they're like, yeah, we didn't spend all our budget, and so we had to spend it. Right? So we all got new computers. Now, what if times were tough? What if we were already over budget for the year? What if we didn't have as much money coming in as we thought? Would we have replaced the computers? No. And we would be saying, wait a minute, we need to replace our computers. And the bosses would say, you guys are going to have to wait another year because we just don't have the money, right? This is why you see computers being greater than 1. They're riskier than the overall market. In good times, the sales go up pretty high. In bad times, they take it down. Does that make sense? Okay. Now, the last one is an outlier. This snapshot was taken shortly after the financial crisis. And AIG nearly died during the financial crisis. In fact, the only way that AIG survived was through a government bailout. Now, I am generally against government bailouts, but this one was amazing. the government got a huge bargain here. This is one of the few things our government does that was profitable, because they bailed them out, and then their stock, after the bailout, the government's holding the stock, right? The stock starts to take off in value because they are recovering. By the way, if you have a near-death experience, when you're at the very, very bottom, does it take that much for you to say, wow, I'm doing better, right? If you can open your eyes, you're doing better, right? And so when the company starts to open its eyes, the stock starts to go up. And then when they start to move around a little bit, the stocks, well, my point is this, that because they were at such a low place, the recovery in their stock price made it look like they had really high returns. The truth is they were just coming back from a near-death experience. But as a result, it made their beta extraordinarily high. If you went back today and measured AIG's beta, I'll bet it would be closer to 1. I'll bet it'd be closer to 1 if we did it today. And if you remind me later on, I'll pull that up on the web and we'll check it out. Okay, any questions about this? What's the beta of the overall market? 1. What's the beta of the risk-free asset? 0. Which is riskier, a stock with a beta of 3 or one with a beta of 0.5? 3, right? The higher the beta, the higher the risk. Now, there is something down here at the bottom that I want you to circle, and that is beta is defined as the covariance of the return on the individual stock with the return on the market divided by the variance of the return on the market. So let's write this out. Beta of stock I is equal to the covariance of the returns on I and the returns on the market divided by the, and I'll write it out in English first, divided by the variance of the return on the market. Now I'm going to put it into the Greek symbols here. So we've got the covariance, R sub I, comma, R sub M, divide by R sub M. Does that look right? That's what the Greek stuff looks like. Now we can ask our Greek student. Is that right? Yeah. Okay, here we go. Now, this is something that you should probably have on your note sheet. Are you ready?
Yes.
We know that the covariance of the covariance between the stock and the market is equal to the correlation between the stock and the market multiplied by the standard deviation of the return on the stock and the standard deviation of the return on the market. And I should make these R's. R sub I, R sub n, R sub I, R sub n. And then we have to carry over this down here on the bottom. Now, something cool happens here. What can we cancel out?
R.
Yeah, this one right here. The standard deviation of required returns, or of the returns on the market, and one of these, right? And so what we get left with here is the correlation between the returns on stock and the return on the market times the standard deviation of the returns on the individual stock divided by the standard deviation of the returns on the market. And so there are really two formulas you should have on your note sheet for beta. Here's one of them, and here's the other one. And that row is correlation. Does that make sense?
Not to the notes, to like your next slide.
Okay. The next slide, we're not talking about that.
You're not.
We're not.
That's where I was looking.
Oh, I was looking at the bottom of this slide.
Yeah, no,
Yeah.
that too.
So this is where they talk about what is the variant, or what is the, how do we calculate beta? And so here's what it is statistically, and when we do some substitution, we can also say it's this thing. So, what you need to do when you find a problem that deals with this is ask yourself, are they giving me covariance or are they giving me correlation? If they're giving you covariance, boom, there you go. If they're giving you correlation, boom, there you go. Does that make sense? Okay. Now let's move on to, obviously, Mr. Nyland is ahead of us. Let's talk about the beta for a portfolio. Remember, we said that when you're figuring out the total risk for a portfolio, you can't merely take the weighted averages of the standard deviations of the individual components because of diversification. But it turns out, remember, that beta is systematic risk. Can systematic risk be diversified away? No, it can't be. And so as a result, all we have to do to find the beta for a portfolio is calculate the weighted average beta for the portfolio the same way that we calculated the weighted average return. It's exactly the same method. We're going to use exactly the same weights to come up with what is the beta of the portfolio. And once again, that's because beta cannot be diversified away. Therefore, we don't have to worry about covariance correlation when we're figuring out the beta for a portfolio. If you've got a portfolio with a beta of 1 and you add a stock in that has a beta of 3, portfolio beta is going to go up. If you add one that has a lower beta, it's going to go down. Questions? Okay. Now let's talk about the security market line. This is the third line that we're going to talk about in Chapter 11, the security market line. And I want you to notice that we still have on the vertical axis, we have the expected return. And on the horizontal axis, we have a measure of risk. But this time, instead of being standard deviation, our measure of risk is beta. Our measure of risk is beta. Okay, now, how can we come up with a line that fits what we see here? Well, hopefully, some of you were actually educated in algebra. And you probably, if you're an American, you remember seeing this formula.
Yes.
Yeah. And if you're from anywhere else in the world, you probably saw it written this way. So that should look familiar to everyone here if they've been through algebra, which you're supposed to do before you come to this class. Okay, this is the slope-intercept form of a line. This is the slope-intercept form of a line, and this is the slope. M is the slope also. And this is what we call the y-intercept. The y-intercept is simply the y value at which x is 0. The y value at which x is 0. Now, if you remember your basic geometry, we know that we can define a line with any 2 points. We can define a line with any 2 points. And it turns out that we already know 2 points on this line. Do you remember that we said the market portfolio, what kind of beta did we say it has?
1.
Yeah, 1. And that's going to be, let's see, that's going to be x, right? That's going to be x. What's the return on the market portfolio? We're going to call it the expected return on the market portfolio. Now, why is it expected? It's a scientific wild-ass guess. Do we know what the return on the market's going to be next year? If you know with certainty what the return on the market's going to be next year, come to my office. We'll get rich together, right? Okay, so there's the first one. We know that the market portfolio has this return. We know it has this beta. And we also know that there's something up here that has a beta of 0. What is that?
Risk-free asset.
Yeah, the risk-free asset, and we know the return on it is the risk-free rate. Why do I not have to put the expected value thing on the risk-free rate? Because it's known with certainty. Because after all, it's risk-free. Does that make sense? Okay, now we can calculate slope. And it is equal to the change in y over the change in x. And we will call this y1 minus y2 over x1 minus x2. Y1 is the expected return on the market, and y2 is the risk-free rate. And down here on the bottom, we've got 1 minus 0. Now what happens to that 1 minus 0?
1.
Yeah, it just, it just becomes 1, right? And when I divide by 1, what do I get? Just the same thing, right? So I don't even have to worry about that. And so, if you are asked the slope of the security market line, a lot of times students want to say beta, but it's not. The slope of the risk-free line is this thing right here. And if we think back to chapter 10, we said that if we take the return on anything and subtract the risk-free rate, that's going to give us the risk premium for that thing. And so there's a magical name for this thing. This thing is the market risk premium. Market risk premium. There are many risk premiums, but this one is the market risk premium. It is the risk premium on the market. Or you might also hear it called the excess return on the market. Okay, so that is what the reward you're going to receive if you're holding a portfolio that's exactly as risky as the market. And so now we've got the slope part down, and we should, by observation, be able to figure out what is the intercept. Can anyone tell me what the y-intercept is? Remember I said the definition of the y-intercept is the value of y when x is equal to 0. What's the value of y when x is equal to 0? Yeah, it's just the risk-free rate. It's just the risk-free rate. And so now we can go ahead and fill out our thing here. And we're going to say y here is the expected return on the individual security. And the slope is the expected return on the market minus the risk-free rate. And then what is that on my x-axis? Beta, right? And so this is times the beta on stock I. So we're looking at the return on stock I is equal to the market risk premium times the beta of stock I plus one more thing. What is it?
Plus 1.
Plus the risk-free rate. Remember, because we're saying it's y is equal to mx plus b. So we've already got mx written up here, so plus b has to be the rest of it. This is plus the risk-free rate. By the way, I'm going to make you derive all this on an exam? Absolutely not. But I want to show it to you for a couple of reasons. First of all, let's just take a look at this and ask ourselves some questions. What if the value of beta is 0?
It's equal to 5.
So beta 0, this whole thing's going to be 0, right? And so the expected return is going to be the risk-free rate. That makes all the sense in the world. Now, what if we are looking at a stock that has a beta of 1? What else has a beta of 1? The market, right? And so if I have a stock with a beta of 1, basically this thing goes away and I've got the expected return on the market minus the risk-free rate plus the risk-free rate. What happens to minus risk-free rate plus risk-free rate? They cancel out. What's left over?
Just
The expected return on the market. It makes perfect sense if beta is 1 that our return will be the expected return on the market because that's what you get for bearing that kind of risk. Now, I want to point something out about this picture. This picture shows beta stopping at zero. It's not true. There are negative beta stocks out there. And it's so funny because the editions of the textbook go back and forth on whether negative beta stocks exist. And whenever they come out with an edition that says it doesn't exist, I always go to my stock screener and I screen for beta less than zero. And lo and behold, I can find stocks. During the financial crisis, Walmart had a beta less than zero. Why?
Because the risk was moving inverse to the market risk.
Okay, why? Let's think about this. Where do you guys, so let's assume that you're all doing okay these days. Where do you buy your clothes? Is it Walmart or is it somewhere further up the chain?
Walmart, because they sell inferior goods.
Let's see, you're jumping ahead here. During good times, people don't tend to buy, or the overwhelming majority of the population doesn't buy their clothes at Walmart. But during bad times, guess what? People are piling into Walmart. During good times, people are out eating at restaurants. During bad times, they're down at Walmart buying groceries. And so it was one of the few stocks that was actually going up when the other stocks were going down. So right in that aftermath of the financial crisis, Walmart had a negative beta. Now, today I don't think they're negative, but that's what was going on during that time frame. Now, here's one that's almost always negative. Gold mining stocks. Gold mining stocks. So think about this. Your costs at a gold mine are pretty much the same regardless of the price of the gold that you're producing. We still have to pay these people $20 an hour. We still have to pay $100,000 a year for electricity and things like that. But your profit is totally dependent on the price of gold. As the price of gold goes up, basically $1 an ounce, your profit goes up $1 an ounce before taxes, right? Okay, now what does that mean? It means that gold mining stocks do really well when gold prices are high, and they do poorly when gold prices are low. Now let's talk about what happens in the economy. If the economy is doing great, are people buying gold for other than jewelry purposes? No. Gold is a safe haven. Gold is where you run to when you are unsure about the future, right? And so during boom times, people are going to have their money out there invested in companies that are creating value. When things get nasty, though, people rush for the safety of gold. When everyone and their dog wants to buy gold, what happens to the price of gold? It goes up. And so this downslope in the economy leads to an increase in the price of gold, leads to an increase in the profit for gold miners, leads to positive stock price moves for them when everything else is being negative. Now, let's talk about what happens when we come out of a bad situation, a bad economic situation. People, they're sitting on all this gold and suddenly they decide, wait a minute, I could do better if I were invested in stocks of companies that are out there creating value. Now, let me explain to you why gold doesn't create value. I can prove it to you. Go out today and buy 2 little gold bars and take them home and put them in your safe. And 9 months from now, I want you to open the safe and see if there are other little gold bars lying around where these 2 gold bars have reproduced. Does that happen? No. Gold does not create value. In fact, gold consumes value, and here's why. Remember I said take it home and put it in your safe? You have to invest in a safe or you have to pay someone to keep an eye on it, because what will people do if you just leave gold laying around? If you don't believe me, just go buy yourself a gold bar, sit it in your front yard and see what happens. It's gone, right? Does that make sense? And so and it's a physical good. So you have to pay to have it stored somewhere, and you have to pay some fella to sit on it with a shotgun.
It doesn't make sense, but like if you take a dollar bill, yes, that's the case.
Okay.
Because the buying power of that dollar is not going to be the same in 20 years.
Right.
As, it is today. Versus gold, which continues to go up in that value.
Does it always go up?
Well, no, it goes up and down, but over a period, long does go.
Well, if you just look at it inflation adjusted, does gold price go up? I don't know the answer, but I'm telling you that gold does not produce wealth. Like, so let's take an example here. Something that we've recently figured out is that there are huge pockets of hydrogen underground. Do you guys know about this? Okay, huge pockets of hydrogen underground. Now, why is that cool? Because we can go out there and we can drill a well, we can get the hydrogen, and when you burn hydrogen, you get the heat to make electricity or run a car. And what is the only byproduct?
Water.
Water. Oh my goodness, do you think people would pay for that? Yeah, so here's what I mean by gold doesn't create wealth. I could take my $1 million or it would probably cost more than like $5 million to drill a well. I could take my $5 million and invest it in gold and stick it in a safe somewhere. Or I could take my $5 million somewhere and drill a hole and hit the hydrogen and then sell the hydrogen until it runs out, which by the way, a lot of these, we don't know how long it's going to go. It could go years and years and years. I am creating value by investing the $5 million in the well for hydrogen. I am not creating any value by buying the gold. Yes, it may go up, but it could also go down.
I just see that as a different risk and reward value between the two, gold being the low risk versus the hydrogen being the high risk. That's, I mean, I still see the value
Yeah.
going on.
Feel free to think that.
I mean, just logically, I mean, I don't know.
Well, just because the value of something goes up over time doesn't mean it's creating value.
Okay, that's fair.
Yeah, well, so think about the amount of money that gets invested in making, this one's a surer bet. Do we know that we are going to need computer chips? Yeah. What if I could take $5 million and go out and buy a machine that makes computer chips versus putting $5 million in gold? I am creating value because the chips that come out are worth more than the raw materials and the cost of acquiring the machine. You're not seeing that kind of value production with gold.
No, I would agree with that.
Okay, very good. Well, then we're just arguing with we're arguing the same
I'm
point.
not really arguing, I'm just saying that I think that the value is just a lot less.
Okay.
And what's his deal?
I'm not saying gold doesn't have value. It does.
What's his deal then with all these gold IRAs and banking in gold instead of dollars?
I have no idea. Well, okay, so let's get down to reality here. The money, I think I have money in my pocket. We'll see. Yeah, okay. What's that worth? $1. Why?
What do we think it is?
Oh, well, but it's backed by the full faith and credit of the United States government, right? What did it used to be backed by? Gold. Now it's what we call a fiat currency. And people have made this argument about Bitcoin. They say, well, wait a minute. This thing's only worth $1 because we say it is. Why can't we say the same thing about Bitcoin? And I suppose there's an argument to be made in that direction. I would also say, though, that this is backed by more than Bitcoin, right? And by the way, what if you unplug every computer on earth of the Bitcoins all go away? Or what if you forget your password? I mean, there's all sorts of bad stuff, right? But this is now a fiat currency. It's worth $1 because we say it's worth $1, right? And what happens in countries where suddenly the dollar isn't worth the currency isn't worth as much? Anybody here lived through inflation recently? Yeah, you guys like, phew, that dollar's not worth as much. I'm going to need more of those to do the same thing I used to do, right? I'm in that boat. The dollar's losing value, and I'm like, hey, Cliff, you need to give me more of those dollars because they're not worth as much as they used to be. Does that make sense? Now, why is gold worth so much?
It's a rare earth metal.
So there's some scarcity involved, right? There's a finite amount, and that's kind of what Bitcoin, in theory, has going for it. There's a finite amount of Bitcoins. But let's ask this question. Does gold have... there's two pieces to gold's value. There's the intrinsic value, because gold is important for some industrial processes to create electrical contacts that don't corrode in space and things like that. There is an industrial use for gold. Do you think that industrial use for gold justifies the prices that we see of gold? No. The rest of it is speculative value. And that's what's floating up and down when you see gold prices going up and down. And when people, the reason that they jump into gold is because they think that the value of the unit of currency is going down. And so they'll be able to trade that gold in the future for more of the units of currency. Does that make sense? So what I'm getting around to saying here is gold is kind of like fiat currency, except for that small industrial use. It's worth what it is because we say it is. And the price goes up and down on it. Is there anything that has intrinsic value in this life that we could truly back a currency with? I have a hard time coming up with something, except for, you can get some really basic stuff like oxygen. We all need that. But then again, it's free. Yep, just got some, right?
It's just because they ain't found a way to charge it for it yet.
Those bastards, I'm sure they're working on it. I don't know who they are, but I'm sure they're working on it. Okay, long story short. First of all, there are negative beta stocks. Secondly, let's take a look at the return on a negative beta stock. If I throw negative beta into this formula right here, I'm going to wind up with something less than the risk-free rate. So I'm going to end up with this thing times a negative number, and I'm going to end up with something less than the risk-free rate. Why would I like, actually I would like to have some of these negative beta stocks. Why would I like to have them in my portfolio? They do reduce risk.
Yeah, as a habit.
That's what you're going to say? I'm going to tell you that the answer has something to do with the diminishing marginal utility of consumption. Let me write that up here. Hopefully you've all gotten this beta stuff written down. This is an economic term, and it sounds fancy, but it's really easy to understand. Let's give you an example. You decide on spring break that you are going to go enjoy the scenic beauty we have available here in Missouri. And you go to the Mark Twain National Forest, and you start out early in the day. You've got a full charge in your cell phone, and as you walk along, the birds sing around you, the squirrels walk beside you, and you're recording everything on your phone, and you're posting it to Instagram and whatnot. And then it starts to get dark, and you say, well, I better make my way back to the car. But then you realize your phone battery is dead. You have no GPS. You have no ability to call on the cell phone. Suddenly you are back to the Stone Age. Now what do? Well, the first day, so the two choices, stay put or walk. What do you do? Stay put. Stay put. If you get lost in the woods, stay put, because we will come looking for you. Okay. Now, that's in this country. Maybe in your home country, you should walk, right? I don't know. Okay, so if you're in the Mark Twain National Forest and you get lost, stay put, because someone eventually will miss you. Hopefully you have friends, and they will report that you are missing, right? And they'll come looking for you, so just stay put. Okay, and so there you are in the woods, and you know you need to stay put, so you stay put. And the first day, you don't eat anything because you're really hungry, but everything looks really gross. On day 2, the tree bark starts to look good, and so you try some, but it's really chewy and it tastes terrible. On day 3, you're so hungry you try to eat a slug. You know what a slug is? It's like a snail without a shell, but it's just so snotty, and you can't handle it. So you eat a little grass, it's like salad. But day 3 rolls around, you are terribly, terribly hungry. And so you decide to start walking. And when you step out into a clearing, there I stand. And I have on a latex glove, and I'm holding a fresh hot dog. if you're a vegan, it's a vegan hot dog. It could be a kosher hot dog. It could be halal. I don't care. But it's a hot dog that's very, very attractive to you, and you're very, very hungry. Now, my question to you is, how much will you give me for this hot dog?
Dead phone.
The dead phone. I like that. Let's assume that you've got currency in your pocket. Let's assume you've got a pocket full of 20s, 10s, 5s, and 1s. What will you give me for this hot dog? 5. 20. This man's hungrier than you are.
Hot dogs are cheap.
What's that?
Said hot dogs are cheap.
I've got a hot dog monopoly, remember? Do you see anyone else standing in this clearing offering you a hot, juicy hot dog? Do you even know where the hell you're at? 20. Okay. So, I'm going to sell Mr. Salas Hernandez the hot dog for $20. He eats the hot dog. Is he still hungry? Oh, come on. Yeah, if you're an American, you know the answer, right? I can down at least 2 chili dogs in one sitting, right? And then I'm a lightweight. Okay, back to the story. So now Mr. Salas Hernandez, he's still hungry, and whoop, I've got another hot dog. How much will you give me for this one?
Less than 20.
Less than 20, why?
And this one.
He's less hungry, right? That's the diminishing marginal utility of consumption. That first hot dog was worth more to him because it did more to improve his situation. The second hot dog is still desirable, but not as much because he's not as hungry, right? And so when I get to the third hot dog, he's probably going to give me $1 or $2 for it. And maybe by the time I get to the fourth hot dog, he'll say, you know what? I'm done with the hot dogs. Now, I've got good news for you. The marginal utility of $1 is always positive. So, if someone keeps offering you money, of course you're going to take the money, but it's not worth as much to you. I'll give you an example using money here. When I was a freshman in engineering school, my buddy and I were sitting in his dorm room. His dad was visiting, and he was like a big deal civil engineer down in Houston. And we're complaining about the price of a textbook, and you guys are going to laugh. We were complaining about a textbook costing $100. And we just thought that was awful. Of course, the year was 1989. Now, his dad says, phew, $100, I'd piss that up against the wall any day. Now, that's kind of crude, but what does he mean? $100 doesn't mean a whole lot to him. And of course, my response was, piss my way, right? Because $100 to me was a big deal. Why? I didn't have any damn money, right? I'm a college student. You guys know how that is, right? You guys are probably, you make somewhere between jack and squat, right? You know what it is to think, yeah, throw $100 at me, man. Now, and he was making $55,000 a year at the time, which was big money in '89. And now that I am a decent wage myself, I know what he means. I know what he means. It's like, yeah, it's $100. Poof. Of course, considering inflation, I'd say, yeah, it's $200. So I was talking to my neighbor last night, told him about this 3D printer I bought, and he was like, whoa, whoa, whoa. And he says, well, how much did that cost? I said, $300. He says, that's nothing. Now, is $300 something to you? Probably is. Why isn't it to him? He's an established professional doing some amazing stuff and getting paid a lot for it, right? Okay, so that's diminishing marginal utility consumption. What does that have to do with negative beta stocks? Negative beta stocks pay off when everything is going bad. Negative beta stocks pay off when everything is going bad. The economy's gone to crap. Your portfolio isn't worth much. You just lost your job. Your partner ran off and took your dog and your pickup truck, right? This could be a country song. Okay, now, what is the only thing in your life that's positive at this point? Your negative beta stocks are up. They pay off when you are hungriest. They pay off when when your marginal utility of consumption is the greatest. Now think about positive beta stocks. When do they pay off? Well, they pay off when you're doing great at work, you're about to get a promotion, you got a big bonus, your partner has hung around, you guys are actually thinking about getting another dog, right? And you're like, oh, and by the way, my stock portfolio is up too, right? It's when it pays off that makes these negative beta stocks worth something to you. Questions? So we've already put an equation to it. I do want to point out that we typically reverse these two things and write it the way it is written up on the screen, which is the expected return is equal to beta times, risk-free rate plus beta times this. So we switch a couple of things around. It's exactly mathematically the same. Now I want to point something out to you here. What happens if I subtract the risk-free rate from both sides? What would I call this? We talked about it in chapter 11, or chapter 10.
Market risk premium.
It's not the market risk premium, it's the risk premium on the individual stock. So, what we have just discovered is that the risk premium on the individual stock is equal to the market risk premium multiplied by the beta of the stock. Let me say that one more time. The risk premium of the individual stock is equal to the risk premium on the market multiplied by the beta of the individual stock. And so let's say that your stock has 3 times the risk of the market. It's going to have 3 times the risk premium. It makes perfect sense because the risk premium is what you get for bearing risk. If you're bearing 3 times as much risk, you should get 3 times as much risk premium. Does that make sense? Okay, and we can take this one step further, and we can say that beta of a stock is equal to the risk premium on that stock divided by the market risk premium. All I did there was divide both sides by expected return on the market minus the risk-free rate. And so the beta is simply the risk premium on the stock divided by the risk premium on the market. Questions? Okay, now I think we actually have time to do this little exercise with finding beta using linear regression. So let's go back here, content. Oh, no. Chapter 11. Okay, so let's talk about what we have here. I went out, and you can tell how many years ago I did this. Some of you were still in like kindergarten when I did this. This is 2007, and the dates are all in backwards order. So we start at the end of 2007 and work our way down. And for each day, I've got the risk-free rate. What did we say was our stand-in for the risk-free rate?
The treasury bill in March.
Yeah, 3-month treasury bill, 3-month treasury bill. Okay, so I went out to the Kansas City Federal Reserve Bank's website. By the way, there are 12 Federal Reserve banks in the United States. What state is the only state to have 2? Missouri. We've got one in Kansas City, one in St. Louis. If you're in St. Louis, go to their site by all means. Chicago is also good. They all have this data out there where you can find this data about the yield on the risk-free asset, which is the 3-month treasury bill. And so that's where I got our sub-F. And then I went out and I got the stock price for GE. Yahoo Finance sucks in many, many ways. But one of the ways in which it is excellent is it allows you to download historical data. Most stock places, you go and you can look at them and you can actually see a chart, but you can't download the data, but you can on Yahoo Finance. And so that's what I did, is I got the stock price for GE. The next column over, I actually calculated the return for GE stock on a daily basis. How do you do that? today's price minus yesterday's price, divide by yesterday's price. And by the way, it's not always yesterday. What if today was Monday? Then the last price was on Friday. What if Friday was a holiday? And then the last price would be Thursday, right? So it's the previous trading day. By the way, how many days are in a year? 365. We typically say there are 252 trading days in a year, give or take, depends. And so what that means is that there are lots of times when you have to look back more than one day. Okay, so for instance here you can see that we skipped Christmas. And that makes perfect sense because stocks don't trade on Christmas. Okay, back to the story. Now I have the return on GE. I can go then and subtract the risk-free rate from each of those returns, and now I've got the risk premium on GE. That's column E. You see that, the risk premium on GE? Then I need the return. By the way, we said what's the stand-in we use for the market portfolio in the United States? S&P 500, right? Now, on the day I was trying to find this stuff, for whatever reason, I could not for the life of me find S&P 500 on Yahoo Finance, but I could find SPY. SPY is an exchange-traded fund that tracks, in theory, exactly the S&P 500. So the return on SPY should be exactly the same as the return on the S&P 500. And so every day I went and I figured out the return for SPY. And I look at today's price minus the last price divided by the last price. That gives me this return. And then once again, I can subtract the risk-free rate. And now we have the market risk premium, right? Okay, now I have enough that I can go out and figure this out. And here's what I'm going to do. I'm going to treat this thing like a line, but I'm going to call this part, this risk premium, I'm going to call that Y, and I'm going to call this X. And through regression, we're going to find, and it's either going to be A or M, depending on where you're from, but it's going to be the slope. And in this case, beta is the slope. But then we should also be calculating there's supposed to be a y-intercept along with this. The intercept term here should be 0. Because I subtracted this risk-free rate off, there should be a 0 intercept term when I do this. Now, how do I make this happen? I'm going to go to data, and there's nothing over here. So I know I've got to now load this thing up. It's already included in Excel. I don't know why they don't just go ahead and put it up there, but here we go. I'm going to go to File, and I'm going to go to, not File. Was it? Well, it has to be File. File, More. Options. Oh my goodness, I hate that. Okay, so More and Options. Now, we're going to go to Data, and let's see. Oh, no, we're going to go to Add-ins, sorry. Add-ins. And now we see they've got the Analysis Tool Pack. I'm going to go down here, Manage Excel Add-ins, Go, and I'm going to select that Analyst Tool Pack. Do I know the difference between Analyst Tool Pack and Analyst Tool Pack VBA? Absolutely not. Does it matter? Just grab the first one and go with it. And we say, okay. Now I'm going to double click on Data Analysis. And it's got all sorts of amazing stuff. Hopefully they showed you this in your QBA class. But one of the things you can do here is called regression, linear regression. And I'm going to say, okay. Now, it's telling me to input the Y range. We said the Y is the risk premium on the stock. And so I'm going to grab this risk premium on the stock. There we go. By the way, why did we have to have one price from the end of 2006?
Because you need the previous trading day's price.
Yep. In order to figure the return. And now they're telling us we need to put the X range. And we said the X range here is going to be the market risk premium. I believe that's this last column. Boom. Okay, and now I'm going to say also new worksheet because I don't want to clutter up what I've got here. I'm going to say okay. And I'm going to make this bigger. And I'm going to go through here. Hopefully you guys know that you can double click this and get it to the width to go to perfectly fit it. I showed this to my mom when she was in her 70s. She thought it was magic. And she's not far from wrong. Okay, so let's talk through what's going on here. First of all, forget multiple R, R squared. R squared is a measure of how well our line fits the data. Our line explains 60% of the variation in the data. Now so coming out of engineering school, if we had anything less than say 98 or 99% on our R squared, we knew we'd done something wrong. And here's why. We were measuring physical phenomena like tensile strength of steel, right? But when you get into finance, now you're into a social science. And things are squishy because we have people involved, right? Every transaction in the stock market represents an interaction between a buyer and a seller. It's a human thing. Okay, now let's think about some other R squareds. For instance, the R squareds on the studies that link smoking to lung cancer, they're down in the single-digit percentages. I'm not saying you should go out and buy a pack of Kools or anything, but we do have, and I have publications with some fairly low R values. So this 0.6 to me, this is pretty good from a finance perspective. Okay, now we can go on down here and we can look at our regression results. And we said two things. One, we said that the slope was going to be our estimate of beta. And the slope on x variable 1 here, the coefficient on it is 0.8935. In other words, it's about 0.89, which is really close to 1. Would we say that GE is similar in risk to the market? It's way safer than the market or way riskier than the market? Similar in risk to the market because it's close to 1. Now, the other thing that we said is that this risk-free rate, or not the risk-free, our y-intercept for this linear regression should be close to 0. Negative 0.707 times 10 to the negative fifth. So if you don't know how this works, here's how it works. 0.00007, right? And we're talking about basically percentages here. And so we're talking about way less than 1%. So it's for all intents and purposes, it's 0, right? By the way, if it were negative 0.707 times 10 to the negative second, it would be negative 7%. So we're really talking about negative, what, 0.007%? It's tiny. It's tiny. Okay. Now, another thing I want to point out to you is the t-stats. Hopefully you guys remember from your statistics class what a t-stat is. And we know that the bigger the t-stat is, the more significant the result is. And I am usually thrilled in my research if I can get a t-stat greater than 2. Our t-stat here, 19.33. I would be dancing if I could get that kind of t-stat in my research. I can't, by the way. Now, what about the t-stat for the intercept? Do you think that intercept is statistically significantly different from 0? Not based on that junky t-stat. That's tiny. That's disgustingly small. We cannot say that that thing is any different from 0. We cannot reject the null hypothesis that the intercept is 0. And so that's how you use Excel to do linear regression. Now, I've got this posted on video out there. You can watch today's video. If you ever need to do linear regression on Excel and you're out in the wild, you can always go to my YouTube channel and look up linear regression and you can see how to do this. It's an amazing tool. Questions?